Can I buy a property inside of a limited company? Well, yes, of course you can. But what are the tax consequences? Well, check out this video by myself and Louise as we'll give you some of those answers. So Ola's saying, are there ways of minimizing tax whilst keeping properties on our own name? And we must remember that Section 24, by the way, there is a video on that. I will try and post links to these videos so you can have a look at that maybe shortly later on. But the idea behind it, that Section 24 prevents you from offsetting the mortgage interest costs against your rental income. So by and large, it means that most people, if not all, pay more tax than they used to. You do get a 20% tax relief from the mortgage interest cost, so we can't ignore that. I've seen some accountants ignore it, and it's actually that's not right. You can get some tax relief; it's just not as much. So it does mean that I would say a large part of 65% of people that I know pay more tax as a result. And Ola's asking, well, I guess you must know about limited companies and moving properties into a limited company, because she said, well, are there better ways than using a company? But I do think we need to think about, well, if you have properties that are going to be purchased in limited companies, there's a couple of things that I think you need to be aware of. The first one is the fact that you've got the money inside the company. And at some point, you might want to extract that cash. So maybe a good cop, bad cop scenario, because I want you to come up with some good things, and I'll just say about the bad things.
Okay.
It's that kind of dark, cold outside. I'm in that kind of frame of mind. So that's a bad thing. The other side to it is mortgage interest costs will be more in a limited company typically than in your own personal name, typically about 1.25% more. If you listen to the Monday night property expert panel, Simon Hodgson always gives a mortgage update in those shows. And that's normally the first Monday of every month. But it's worth watching that because he does talk about all the products that you can get. So that's some of the downside, but let's not have too much of a damp squid on this show. What are the advantages here?
Well, corporation tax is a lot lower than income tax if you're already a high rate taxpayer. It's half right now, quite frankly, slightly more than half reduced. The other advantage is that it's technically separate from you as an individual. So if something were to go wrong, and your portfolio was to be sued over or litigated over, then if something were to go wrong, so long as you've done it in the right way, so to speak, in terms of setting it up and structuring it, then actually the liability won't fall on your personal shoulders, it will fall on the shoulders of your limited company. So it does have some advantages, but I'm mindful that Ola specifically said what things can be done outside of a limited company.
Yes.
If I've already got the asset in my personal name, I'm kind of stuck there. What can I do? Well, there's lots of things you can look at. And the first thing I would always say is be absolutely rigorous in capturing every single expense that you're incurring on your property business. You'll be amazed how much is out there in terms of all the expenses. Things like mileage. Don't forget your mileage if you're traveling between your properties. Items such as use of home. There's a flat rate expense that HMRC don't even need you to have a receipt for, but would be happy for you to claim every year so long as you meet the certain criteria that they have. On top of that, also look at ways in which you might mitigate Section 24, either because you might convert your property to, for example, a furnished holiday let, meeting Help Sheet 253 conditions. Go and Google that. HMRC sheet that explains all the conditions you need to meet to be classified as a furnished holiday let, serviced accommodation, some might call it, and get out of Section 24. I like that one a lot. Maybe even looking at reducing your total mortgage in place, which I know is a blasé and very quick way of saying, just put tens of thousands of pounds from your back pocket. Why don't you? Against your mortgage costs. But actually thinking about how you're going to pay those down so they become less and less and less as part of your portfolio could be a great strategy as well. Maybe even this is the time to take the plunge to go, well, actually, I am earning enough from my property business. Perhaps I can give up my day job if you're doing a day job as well. And that will bring down your income such that perhaps Section 24 is not so much of an issue if you're falling, for example, within the basic rate tax bracket. So there's loads of things that can be done if you happen to own property in your personal name.
Well, just on that though, let's stick to that, because what happens if you've got husband, wife, civil partners? May not be both high rate taxpayers.
No, there might not be. And that's the point when something such as a deed of trust, shifting the income and the benefit associated with that property, could be moved around the two of you to make sure that you are maxing out your tax efficiency. So we often see clients come to us who one of the spouses happens to be at a much lower tax rate than their partner, and yet the income is shared 50-50 between them on their property business. Utilising simple deed of trust methodologies, there's a very strong, fast way to minimise tax, and it doesn't trigger other taxes either. So lots of ideas there. It works only, unfortunately, for people who are, as I say, married or in a civil partnership. So just be careful.
Yeah. And Ola's mentioned the question, it should mention at the bottom here, can I transfer the ownership of the limited company? Yes, you can. Anyone can transfer property from their own personal name at some future date. The problem is with this, Ola, and anyone else listening in, is if you purchase the property in your own name to begin with, what's the purchase tax that you pay?
Stamp duty, land tax.
And if you transfer the property from yourself into a limited company, what's the purchase tax?
Stamp duty, land tax plus 3% minimum.
Okay. So we've shot ourselves in the foot because we've already paid stamp duty land tax, but we're about to pay it again now because we're doing something retrospective. And that's the danger with tax. If you do things retrospective, it can cost you thousands by just mistakes. Ola's asked the question is, can I transfer the income from my personal name into my limited company via a management agency? And obviously there's a 4-letter word, isn't there? And I'll let you describe what.
I'm not sure which one you mean. The wonderful word of GAR.
Right, there you are.
General Anti-Abuse Rules. You need to be careful that if you are deemed by HMRC to be shifting income such that you're doing it for tax efficiency purposes, then I'm afraid you might fall foul of GAR and they might refuse it, or they might investigate you and identify they feel you've met the GAR principles in terms of doing things the wrong way, and then they'll unpick everything you've done. So that could mean unpicking tax efficiencies in your personal name, as well as unpicking tax costs in your limited company. So it's not a great way of doing things. You have to be very careful. So what I would say to you is if you are considering perhaps income shifting, other than via a deed of trust, for example, between you and a spouse, go talk to a tax advisor accountant to make sure what you're about to do isn't A, going to trigger taxes you weren't aware of, or B, fall basically short of a HMRC standard that's now captured in law.